Income versus wealth. The key distinction. First, we need to clear up a common misunderstanding. Taxes are mostly designed to capture income, not wealth. If you're like most people, your income comes from a paycheck. You work, you get paid, and the government taxes that paycheck. Simple. But the ultra-rich, they don't rely on wages. Instead, they rely on assets, stocks, bonds, real estate, businesses. And here's the crucial difference. While wages are taxed at high ordinary income rates, up to 37% in the US, wealth that grows through investments often isn't taxed at all until it's sold. Even when it is, capital gains taxes are lower, usually capped at about 20%. That's the first secret. The rich earn differently than the rest of us. Capital gains and the power of assets. Let's say you make $100,000 in a year. If that comes from your job, you're paying a big chunk in income taxes. But if you're wealthy and your $100,000 comes from selling stocks you've held for a while, you might only owe around $15,000 to $20,000. That's why billionaires prefer owning assets over earning salaries. In fact, some CEOs famously take almost no salary at all. Elon Musk, for example, used to take a salary of less than $1 at Tesla. Why? Because his wealth doesn't come from a paycheck, it comes from Tesla stock. Borrowing against wealth, the billionaire's ATM. Here's another clever move. Instead of selling assets and triggering taxes, the wealthy borrow against them. Imagine you own $1 billion in stock. You don't want to sell it because you'd owe millions in taxes. Instead, you go to a bank and say, "Hey, I've got this stock. Can I borrow $100 million against it?" The bank says yes, because your assets act like collateral. Now, you've got $100 million in cash. But here's the trick. Loans aren't income. That means you can spend that money on mansions, yachts, or even more investments without paying a dime in income taxes. And to make it even sweeter, the interest you pay on that loan might be deductible. This strategy is sometimes called buy, borrow, die. Buy assets, borrow against them for cash, and when you die, pass them on to your heirs tax-free through something called the stepped-up basis. Real estate magic, depreciation and deductions. If there's one area the wealthy love, it's real estate. And it's not just because they like big houses. Real estate is packed with tax breaks. For example, investors can deduct mortgage interest. They can also write off property taxes, maintenance, and even travel expenses if they visit their properties. But the biggest trick is depreciation. Depreciation allows you to treat a property as if it's losing value every year, even if the property is actually increasing in value. So, a billionaire landlord could be collecting millions in rent while showing paper losses on tax returns, sometimes enough to cancel out other taxable income. That's how former President Donald Trump, according to reports, was able to pay very little federal income tax in certain years despite being a billionaire on paper. Offshore havens and corporate games. Now, let's go global. Multinational corporations, and the billionaires who own them, are experts at shifting profits to countries with low or no taxes. Ever wonder why Apple and Google have offices in Ireland or Bermuda? It's not just the beaches, it's taxes. This strategy, called transfer pricing, allows companies to attribute profits to subsidiaries in tax havens, even if most of the sales happen in high-tax countries. And for individuals, offshore trusts or shell companies provide another way to legally park wealth where the taxman can't easily reach it. The famous Panama Papers leak exposed just how widespread this practice is among the global elite. Charitable foundations, philanthropy, or tax play. Another popular strategy is creating a private foundation or a donor-advised fund. On the surface, this looks like pure generosity. Billionaires donate millions to charity, which reduces their taxable income. But here's the twist. When they put money into their own foundations, they still control how it's spent. The money isn't really gone. It's just moved into a tax-advantaged vehicle that can also enhance their public image. That's why you see people like Bill and Melinda Gates channeling billions into their foundation. Yes, it funds incredible projects worldwide, but it also comes with major tax benefits. The carried interest loophole. This one's a favorite of Wall Street. Hedge fund and private equity managers often take their pay in the form of carried interest. Instead of being taxed as regular income, it's treated as a capital gain, meaning it gets the lower tax rate. This loophole has been criticized for years, and both Democrats and Republicans have promised to close it. Yet somehow it survives, thanks in part to strong lobbying from the financial industry, inheritance, and the stepped-up basis. Perhaps the most powerful wealth preservation tool is the stepped-up basis rule. Here's how it works. If you bought a stock for $10 and it's worth $100 when you die, your heirs don't pay taxes on the $90 gain. Instead, the value steps up to $100, and if they sell it right away, there's no tax bill at all. This means billions in unrealized gains can pass through generations untouched by the IRS. For families like the Waltons of Walmart or the Mars Candy Dynasty, this rule helps keep their fortunes intact across centuries. Business deductions and lifestyle perks. Finally, let's not forget the everyday tax perks of owning businesses. When you're wealthy and run a business, many personal expenses can be written off as business deductions. That luxury SUV? It's a company car? That vacation to the Bahamas? If you held one meeting, it might be a business trip. Even private jets can be justified as business expenses. For regular workers, these things come out of pocket. For the wealthy, they're tax-shielded. Is it fair? Now, after hearing all this, you might be asking, is this fair? Well, fairness is subjective. These strategies are legal. In fact, tax codes are often written with these loopholes intentionally to encourage investment, charity, or business growth. Critics argue that this creates a two-tiered system, one for wage earners and one for asset holders. And since the ultra-rich mainly live off assets, they benefit disproportionately. Supporters counter that investment fuels the economy, creates jobs, and grows wealth for everyone. Still, surveys consistently show that most ordinary taxpayers believe the system is rigged in favor of the wealthy. Real-world examples. The strategies we've discussed aren't just theoretical. They're used by some of the most famous billionaires in the world. Jeff Bezos, for instance, reportedly paid no federal income tax in 2007 and 2011, thanks to carefully balancing his investment losses against his gains. Elon Musk has also had years where he paid no federal income tax, largely by borrowing against his Tesla stock rather than selling it and triggering taxable gains. Warren Buffett, who is known for his candid reflections on wealth, has openly admitted that his effective tax rate is lower than that of his secretary, a fact made possible by the favorable tax treatment of capital gains compared to wages. These examples highlight that the ultra-wealthy aren't breaking the law. They are using the rules of the system to their advantage.